Okay, Assalamualaikum again to all of you. And today, what we're going to do is we are going to deal with accounting for depreciation, and we will go further by looking at what happened if we add extra asset to our list of assets. So, what we're going to do is we're going to use this question that is example two that in the example list that I have given you. So you can check that in your Google Classroom. And this one is example two. Example two here is dealing with accounting for depreciation with addition of a new PPE. So when I say addition means there are new purchase of a PPE, and the new PPE here can either be any types of PPE. And what is my highlights today is that in this example, we are going to look at depreciation calculation, right? And our focus will be on straight line method as well as reducing balance method. And in this particular example, our basis is monthly basis. What is actually monthly basis? Monthly basis, as I've put the emphasis during the lecture, is that you are going to charge month to month depreciation, meaning that it will be based on monthly ownership. So if let's say the asset you purchased during the year was just for, let's say for 9 months, you are just going to charge depreciation for that 9 month only. So if you purchase the asset for just 5 months, you are going to also charge the asset depreciation for just also 5 months, right? So that is the case. So let's look at what you have here, the balances of the property, plant and equipment of Sumi Berhad as at 31st of December, year 10. Okay, year 10 here is not the current year. Year 10 is the record from the last year. So here you have the asset, the cost, and the accumulated depreciation of a separate asset. Number one is for equipment. Equipment, there is only one equipment here, equipment A, yeah, which is the first PPE. The second one is motor vehicle X. So basically, this one was the one that was purchased in the past. So you are not informed when was the date, but the cost of equipment A was 180,000, and the accumulated depreciation of equipment A is 55,000. So this is very important because this one will later be shown in the notes to the PPE. The cost will be the balance at the beginning of the year in your notes to the PPE, and the accumulated depreciation would be the balance at the beginning of the year for your accumulated depreciation of the equipment. Same goes for motor vehicle X as well as motor vehicle X accumulated depreciation. Here is the challenge where you have the information regarding the company that provide depreciation as follows. So the depreciation that was provided, it was 20% per annum. 20% per annum means that is going to be 20% the rate, and you are going to charge that reducing balance method. Reducing balance method means it will be charged based on carrying amount, yeah, and you are using monthly basis. Monthly basis means you are going to provide depreciation according to the month of ownership. So reducing balance for the previous asset, which is, let's say we are talking about equipment A, you are going to provide depreciation based on the carrying amount, where the carrying amount is actually cost minus accumulated depreciation. So if it's cost minus accumulated depreciation, you would have what you call carrying amount. And the carrying amount for, let's say, equipment here is 180 minus 55. That was 125. So that is the carrying amount that is for the equipment. For motor vehicle, this one is also 1 to, how much is it? You calculate for me. That was, how much is it? Can you do it? Right? But I'm not going to concern so much about motor vehicle because I am concerned about equipment A, since that is using reducing balance method. For equipment B, it is using a straight line method. Yeah, straight line method. How do I know it is using straight line method? Because it means it has the word here cost. The word cost here simply means that the depreciation under straight line method SLM is actually based on depreciable cost. So depreciable cost is actually cost minus the residual value if you have any. So in our case, there are no such thing as residual value because no information, but the cost that we are highlighting, or the one that I was highlighting just now, was actually the depreciable cost. So in your case, depreciable cost is also equal to the cost itself, since there are no residual value. So depreciable cost is going to be also 250,000. So that one, it would be for the case of the motor vehicle. So the depreciable cost is 250,000 minus zero, and that will give you again 250,000. So that would be the figure that you would use to calculate the depreciation for the existing equipment. Okay, let's see what you have here. You have the second part, which is regarding some purchase that took place. So you have some acquisition or addition of uh, several items here, where you purchase equipment, another equipment, which is equipment B. And that equipment B, the initial cost was 85,000. So when you purchase, you need to record that. That was on 1st of April year 11. The purchase was on 1st of April year 11. And be careful, when it was 1st of April year 11, you need to understand that our year, current year, is 31st of December. This is our current year, 31st of December, right? So if you purchase on 1st of April, you need to write the date, 1st of April. And at the same time, this is monthly basis. So when it is monthly basis, for the equipment, regardless equipment A, equipment B, they will be charged on monthly basis. So therefore, the asset is with you for just how many months? 9 months. 9 months. Why 9 months? Because you purchase on, that was already written there, 9 months, yeah. 9 months. Okay. You purchase on 1st of April. From 1st of April until 31st of December, that was only 9 months. For the second asset, that was the motor vehicle, you purchase on 1st of August. So from 1st of August up until the 31st of December 2000, year 11, that was actually 5 months, 1st of August until 31st of December. So why do we bother about this? The reason is because our depreciation is going to be the monthly basis. So all payment of this asset that were purchased were made by check. So made by check means it will involve bank account, right? So this is what you are required to do to calculate the depreciation for the equipment. So you're going to calculate depreciation for equipment B, equipment A, motor vehicle X, and motor vehicle Y. And also to do the journal entries, you have the answer there. I just want to explain. Okay, what you need to do is you need to split between existing equipment and, sorry, between the existing equipment, which is equipment A, and the new equipment when you calculate depreciation. Why do you need to do that? Because under the reducing balance method, equipment A is existing equipment, so it should be based on what? Cost minus accumulated depreciation. This now we calculated it, right? It was 125. So this is the cost and minus the accumulated depreciation, AD, accumulated depreciation. So that will give you the figure to be yeah, to be 25,000 times 20% times 1 year. So that was for the first item. For equipment A, monthly basis, you still charge 1 year because the equipment A has been with you for quite some time. So in the second year also, you will provide full depreciation because we only use the fraction for the new equipment, for the asset that was purchased in that current year, right? For those asset that has been there in the company, the existing equipment, equipment A, you will charge full year depreciation. And you can see here that we take the carrying amount. However, for the asset equipment B, you take the cost, not depreciable cost. It's the cost that you purchase here. This one, this cost. I will use purple. Okay. That cost is the one that you include here. Any questions so far? Any question?
No, madam.
No, madam.
Fine.
No, madam.
Okay. Now that you can see that I minus zero here. Minus zero here because there is no accumulated depreciation because it is a new equipment, right? So it is actually just based on cost. You don't have to minus zero. You can just leave it like this. Fine, right? Or if you are so interested with the zero, you can do that as well. So I just leave it as it is. Times 20%. And now you can see that I include the fraction here, 9 over 12. 9 over 12 here refers to this 9 over a month here. 9 month here. So that 9 month period is actually 9 months from the proportion of the year, which is 12 month. So you have 12,750. And the date is actually from the date that I have listed here from 1st of April up until 31st of December year 11. So that is the 9 month period. This date here. You provide starting from 1st of April. You will not provide starting from 1st of January because you purchase on 1st of April. Okay, now you get the first item, which is your item of depreciation for equipment. That was the first item, right? The next one, when you have this, we will just do focus on calculation first. We go to the motor vehicle that is adopting straight line method, but still monthly basis. So what you can see here is that both have monthly basis. Both have the same basis, only different method. Okay. Next, you have existing motor vehicle that were from the balances given is motor vehicle X. So that was your existing motor vehicle X. So for motor vehicle X, I calculate it separately. The reason is because motor vehicle X were from the previous balances. So motor vehicle X, we are going to take 250,000. Remember, this is straight line method. So that is the depreciable cost times 15% the rate times 1 year because you charge full year for the existing asset, right? And you have 37,500. And for the new motor vehicle, which is the new motor vehicle, the one that you purchased in August. In August, right? You purchased from August up until 31st of December, that was 5 months. 5 months. Okay, 5 months. Right? And that 5 months is here. Right? And how do you get 5 months? 1st of August until 31st of December times 15% times 90,000, which is the straight line method based on the depreciable cost. So you have 5625, add them together. So this one will give you 43,125. That 43,125 is what you recorded here. So you can see here the purchase of the equipment. The first one, you can there is a date there. Please include the date. Yeah, 1st of April. Do it according to the chronological order. And then the second one is on the purchase of motor vehicle Y. This one is equipment B. So this is the record, right? And now we look at the depreciation. So depreciation that were provided is the one as at 31st of December. So the one I have to stop for a while because this one is giving me problem. Never mind. I go to the other screen. Can you see the image?
No,
Hello?
no, madam.
So it was like suddenly blank. What happened actually? I also don't know why it becomes like this.
Uh,
Never mind. I will just open it up again. Just hang on, yeah. Just wait. Oh, it's not there. This is the thing that I don't like about being live because sometimes this would happen. I try again, yeah. Okay. Well, I go straight away to the part here that we were discussing just now. Okay, here, um, example one, okay, example two. So you can see that the figure 85,000 was for equipment B, motor vehicle Y, and the depreciation just now was 37,750 from here, here, 37,750. So whatever you calculated, you will now do the journal entry. You will now do the journal entry. So that is the journal entry that you have. Okay, that's it for the journal entry. This is done for the year ended 31st of December, year 11. And that is done for the equipment that is in the company, A, B, C, D, E, F, whatever equipment, right? And when you debit depreciation, this is actually going to the statement of profit or loss. So it would be in the statement of profit or loss. That is an expense. So it will go to the statement of profit or loss. And you need to understand that that will be part of the expense. Okay. This is the impact in the statement, in the notes to the PPE. So I want you to focus on this part, notes on PPE. Earlier on, I mentioned to you that the one that will be the balance at the beginning of the year are the one in the existing figure there. So if you can see this figure here, it is actually from here, from these two, 180, 180 and 250,000. So these are the two things here, 180 and 250,000. First you do that and then get the total. Yeah, then you get the total. Then go and put the accumulated depreciation. So the accumulated depreciation is, I use blue. Yeah, just I use blue, a different color. And you can see that that is here. So put the balance because that is the one from 31st of December, year 10. So it is actually the one as at January, year 11. Okay, for the addition, addition is the new purchase, right? So for the addition, this one, 85,000 is the one here, 85,000, which is from the transaction on 1st of April. And this 90,000, yeah, is the one here, which is from the transaction on 1st of August. 1st of August, right? 1st of August, you have the transaction. I take a different color so that it can be differentiated. Okay, right. I do not know why it does not want to work. Okay, so that is 90,000 here, right? Next, So you can see that. Then the depreciation here is taken from here and also from here. Or if you are doing for published account, you can take directly from the working. Take from the working, take from the working. It will be included in the notes to the PPE, right? So after you have total up the costs and you have total up the accumulated depreciation, and you take the cost at the end of the year, 265 minus this 92750, you get this. So that will give you the carrying amount for equipment, and this is the carrying amount for motor vehicle. So what you would transfer to the statement of financial position is the carrying value, carrying amount, which is the one here. Okay, that's it for the first part. For the first part, which is on the carrying value, and also on the presentation, with if we adopt the straight line method and reducing balance method using the monthly basis. So I'm done with the first question. Sorry, with the example 2. So now what we are going to do is we are going to look at example 4. Example 4, yeah. With the hope that everything would be okay here. So let's look at example 4. Are you with me? Are you still there? Don't just leave your Gmeet on and you are somewhere else, please. Please make sure
No,
you are with me, or else you will miss this important explanation. Right. Okay. We are going to do example 4. Okay. Example 4, and I'm putting it side by side. I'm going to work out that together with you. And example 4. But this one I will just make it bigger first. Okay. Look at example 4. Example 4, things get more complicated because you are now not only dealing with addition of an asset, right? Not only addition, but in the example 4, you also deal with disposal of asset or derecognition of PPE. Derecognition of PPE. Disposal, or that is also known as derecognition. When you decide to dispose the PPE because of to get some cash, or maybe to get profit from the sale of PPE, or maybe because the asset were no longer providing the future economic benefits, can no longer generate revenue for the company. So for this question, we are still focusing on monthly basis, right? And only that the asset is getting more and more here. So let us look at the list of asset that you have. You can take your highlighter and highlight your question as well, the way I did, because I want to differentiate things. I will normally use colors. So these are the existing balances of property, plant, and equipment that were available from the last year record, which is on 31st of December, year 11. That was last year, right? Or this is what you call in accounting, these are called prior year or prior period. Okay, accounting use the term prior year or prior period. So these are the asset that you have, equipment A and equipment B. Yeah, you have equipment B. There are two equipment, two types with different model. So then you have the date of purchase is not given, but you are given the detail of that. What was the cost, what was the cumulative depreciation. Same goes for motor vehicle. There are two set, which is X and Y, different. Maybe this one is imported, this one is being the local motor vehicle. This one is imported equipment, maybe this is the local equipment, yeah, local brand, for example. Here you have the cost, right? and then the detail of what you have. No information regarding when was the date of purchase for all the existing equipment. That does not matter because that is our issue is here. Here, yeah. Okay, you have the policy of the business to provide depreciation as follows. 20% per annum, reducing balance method, monthly basis. You know, monthly basis means 1 month ownership requires 1 month depreciation. And again, the motor vehicle is provided using the straight line method, and motor vehicle is provided on cost. On cost, that is going to be again what? On cost, it means that is going to be based on the depreciable cost. Here are some purchase and disposal of asset. So take some close look now. This is the asset purchase, and there is another one, the asset that is being disposed. So purchase, I will use a different color because purchase I use green. Yeah, I use green, and dispose I will use red color. Okay. So what was disposed is not relating to motor vehicle, is not relating to motor vehicle that was being purchased, but that was about equipment. So asset that was purchased is another equipment, equipment C. And the cost of the equipment is 160,000, and the date of purchase is 1st of October, year 12. 1st of October, year 12, up until 31st of December year 12. This is the current year again, current year. So from 1st of October until 31st of December year 12, there was how many months? Three? Is it 3 months?
Yes, 3 months.
Yes.
3 months. Okay. Are you with me? I think you are with me. Please be with me. Don't leave me alone. I am alone in my room already. Okay, 3 months. Why do I bother about this? Because later that would affect the calculation of depreciation. Let us look at equipment A. Equipment A is this equipment, the yellow one here. It is 180,000 when you purchase. The accumulated depreciation was 80,000. And of course, the carrying amount would be how much? Carrying amount would be 180 minus 80. So the carrying amount would be 100,000 because cost minus the accumulated depreciation. On the day that you dispose, the proceed that you get is 115,000. So meaning that is quite okay, even though when you purchase was 180, when you dispose was 115,000. So we have to find out what are the profit or loss on that disposal, as well as do we need to calculate the depreciation for that asset being disposed. You dispose on 1st of July. So when you dispose on 1st of July, wait, yeah. Oh, I didn't write anything here. So basically, that was actually under straight line method. So under straight line method, right, you dispose on 1st of July, and this is actually from 1st of January, year 12, until 30th of June, year 12, the asset is still with you, right? Do you agree that from 1st of January until 31st of December year 12, the asset is still with you? So meaning that for this 6 month, the asset has not yet been disposed. Are you following me?
Yes.
Yeah? So 6 months is still available. So only on 1st of July, you dispose. For this 6 month period, 6 months prior to the disposal, date. Disposal, 6 months prior to the disposal date. So you still need to charge the depreciation. So meaning that you need to look at the fact that you need to charge depreciation. Why? This is because it is monthly basis. So for monthly basis, in the year of disposal, So this is the year of disposal, which is year 12. This is the year of disposal. I put here YOD, year of disposal, year 12. And for that year, you still provide depreciation. Why? Because that was monthly basis. However, for monthly basis, yeah, if this is, let's say, if the company use yearly basis, if the company use yearly basis, so that is in example 3. Example 3 is yearly basis. Example 4 is monthly basis. If company uses yearly basis, what happens is that there is no depreciation in the year of disposal. So for yearly basis, no depreciation. For monthly basis, there will be depreciation in the month that it was still with you. So this one would be the case for in example 3. Okay, example 3, it uses yearly basis. So if you use yearly basis, no depreciation in the year of disposal. If you have the time, we can go through that in a short while. But now we are focusing on this. So we will have to provide depreciation for the asset that is being disposed in the year of disposal. And that is only true if you are using monthly basis. However, if you are using yearly basis, in the year of disposal, no depreciation will be provided. Nothing will be provided for the equipment A in terms of depreciation. But here we will provide. So all payments were made by check, right? So that is what happened. Let us go to the side-by-side discussion here. Okay. What you are asked to do is you are asked to calculate the depreciation of the equipment, right? So, and also the motor vehicle. So let us look at what I have prepared here for you, which is example 4, right? Okay, before that, I will just make this gone. What do you mean by gone? No more. No answer. Nothing. Okay, let's start from the beginning. Right. So for equipment, we have 3 equipment. So we will start off with the equipment A. Equipment A. Equipment A because it is A, B, and C. A is the one that you own and you decide to dispose. B is the one that you own and it is still there. Right? Are you following me? C is the one that you just purchase. Okay. So let's do this for the first item. For the first item, you would be doing for A. So for A, it is the disposed equipment. Why do I say disposed equipment? It was first with you and later you decide to dispose. So what you dispose is you dispose the existing equipment and that was existing equipment A. Yeah, existing equipment A. I'm trying to put A here. So existing equipment A, you are going to provide depreciation. Remember, I mentioned to you earlier, you are going to provide depreciation for 6 months. So that's why you have here 180 minus 80, which is cost minus accumulated depreciation. This one, 180 minus 80. So I will just take this to be yellow. Yeah, I will use yellow here. Right? So that is reflecting equipment A. So you can refer that in the next document here. All right. So you multiply by 6 over 12. And that was 10,000. Okay, done with the equipment A. So equipment A is being disposed, but you still provide depreciation when? For the 1st of January until 30th of June. On 1st of July, no more depreciation. Why you dispose? The second one is equipment B. Equipment B is the one that I put gray this just now, equipment B. And that is going to be provided. How? You are going to provide depreciation for 1 year. Why 1 year? Because equipment B was existing equipment. So equipment B, existing equipment. So this is equipment B. Equipment B, yeah? Equipment B. Right. Equipment A is here. Equipment A. Right. So you take 85,000, which is this 85,000 minus 12,750, the accumulated depreciation. Why? Because you use reducing balance method. So under reducing balance method, and you charge monthly basis, even though monthly basis, the asset is with you for more than a year already. So that is going to be charged for 1 year, 14,450. You need to do it set up, how do I say it? One by one. You need to do first for equipment A, B, and now we are doing for the new equipment, equipment C. Equipment C is the one that you purchase when on 1st of October. So because it was purchased on 1st of October, you will provide depreciation for just 3 months, because from 1st of October up until 31st of December, that was 3 months. And there are no such thing as accumulated depreciation that will involve, because this is a newly purchased asset. So you have not yet provided depreciation, and only in the following year, year 13, that you will concern about accumulated depreciation. So here 160,000 for that year is based on the cost, since this is the first year of acquisition, times 20% times 3 over 12, you have 8,000. And with that, you will have the figure total here would be the figure 32,450. And this 32,450 is actually the total depreciation for all equipment that you have, total current depreciation. And that is the one that you will record here in this journal entry. That the one you will record here, this one. I'm just putting the color correctly so that you won't get confused. Okay. Right. Now let's look at the next one, which is the motor vehicle. Motor vehicle is an easy peasy thingy, where motor vehicle is dealing with the straight line method. Straight line method, monthly basis, you will repeat the same as what I've done. So first do for the asset that were remaining asset, motor vehicle X, which is the existing one. Yeah. You can also join them together and do it X and Y as one calculation, but I would suggest you to do it separately in case you make mistake. And then you have another one, which is motor vehicle Y. So you can join them together by taking 250 plus 90 times 15% times 1 year. You will get also the same answer, which would be the figure 51,000. That would be the current depreciation for motor vehicle. But it's best to do it separately in case you have many motor vehicles and those motor vehicles are related to different function of the company, right? So you put it separately. So 51,000 here. So that was a calculation. And here it will involve some derecognition of equipment. That is the derecognition of equipment that happened on, when was it being disposed? That happened on 1st of July. 1st of July to the year 12. So that was the disposal. So what you will do is, we're now doing the recording, right? So for the derecognition, first is to do as what I have already mentioned in the lecture, to remove the accumulated depreciation of the equipment. So what were the accumulated depreciation related to the equipment? This is the one, this. So I'm going to use yellow again. which is this 10, and also the 80,000. 80,000 here is from here, this 80,000. Equipment A, accumulated depreciation 80,000, the one from the previous year, plus the one that you have just calculated for the current year. So the one in the current year was 10, 10. The one from the balance of the same asset, the accumulated depreciation of the same asset in the previous year was 80,000. And what you are interested is the accumulated depreciation here on the date of disposal, or on the date 1st of July year 12, that you need to eliminate would be 90,000. 80 from last year, the current year depreciation CYD is 10. So you have 90,000. That must be eliminated. So you need to debit accumulated depreciation, that part. And then the disposal proceed is the one that was given in the question. So the disposal proceed is here from the proceed of the disposal, 115. This one, 115. So it is 115 here. And the next thing is to go and remove the asset being disposed. So this one is the cost being disposed. Cost being disposed here refers to cost of the equipment A. Derecognition of equipment is derecognition of equipment A. Yeah. So you have that equipment that you need to remove, because when you dispose, you need to go and also remove from the record of the company. Not just remove the equipment A physically, but also remove all the accumulated depreciation, and also the remove the cost as well. So if you look here, this red figure here and the yellow one here, 180 minus 90 is 90,000, right? So that one is actually the carrying amount. So 180 minus 90. Okay, that will give you the carrying amount. The carrying amount is 90,000. 180 minus 90 is 90,000. So the carrying amount 90,000, right? If you compare with the disposal proceed 115, disposal proceed 115, you would see that there is the disposal proceed is greater than the carrying amount. Recall the lecture. If you forgot what I mentioned about the lecture, go and rewatch the lecture as many times as you like. Okay, so not debit, we are talking about the disposal proceed, DP, minus CA is carrying amount. How do you get CA? Cost minus accumulated depreciation that were being eliminated. So these are the one that were being eliminated. 80 plus 10. So 90,000. So that will give you 25,000 of gain. And that gain is the one that you will be crediting to the statement of profit or loss as gain on disposal. And this is actually part of other income. Part of other income. So you have that, the first one. Now we go to the next one, which is the record for the addition of equipment that happened. When was it? On 1st of July? No, that was on 1st of October. This is on 1st of October, year 12. So these are the to recognize the acquisition of equipment C. So record that. And the depreciation here is the one that is done on 31st of December. December that year. So I put here 31st of December year 12. So that is to recognize the depreciation. To recognize the depreciation on 31st of December. And this one is to record the addition of equipment. And the depreciation for motor vehicle will also the one that were being recognized or provided on 31st of December. Okay, so the journal entry, the figure here is from the calculation that we have done earlier. So 51,000 is from this 51,000. But you need to work out this first, all this correctly, right? Okay, this kind of question has never been asked in the exam yet. Tak pernah tanya lagi. Yeah? So just do not know when. So we just need to be prepared. I guess that's the most important thing is that we need to always be prepared. Right. So let's just give some space here. All right. Right, that was the impact. And for your information, depreciation is an expense. Of course, it will be in the profit or loss. Right? Okay. Now let us look at the impact in the profit or loss. Let's look at this in the profit or loss. Depreciation of equipment is what we colored earlier as, what was the color? Green. 51,000 is depreciation of the, are you with me? Hello? Woo.
Yes,
Yes,
madam.
madam.
Yes,
Yes,
madam.
yes,
Yes,
madam.
You
madam.
are focusing, right? Are you focusing? Can you follow what I'm explaining?
Yes.
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 Yes,
Yes,
I'm
Yes.
madam.
focusing.
Alhamdulillah. So this 32,450 is depreciation of equipment. You know it's from here, right? This 51,000 is for motor vehicle. Okay, you include other admin expenses. Unless motor vehicle is used for selling purpose, so that would be under distribution and selling. Gain on disposal is this figure here. So let us just put some color for this so that it's easy to you for us to, okay, this is the one here, right? Now we're going to look at the item here. Okay, the addition, say let us look at the notes to the PPE. Before that, I just want to check on the color that I use. So I use equipment red. Was it red? Equipment. Okay, never mind. Okay, I use this one for equipment. I was using yellow, if I'm not mistaken. Right? And so you would see that there is an addition in the equipment section, as well as there are some disposal. So there was some disposal of equipment, right? That was 180,000. That first you add equipment that you add is in this color, I think, not that one. This one, right? And the one that you dispose is 180,000. 180,000 is equipment A. This one, I want you to understand what we are doing. That is equipment A is what you dispose. So I'm just putting this in bracket. So do not write too much of item here. Yeah. Just want you to know I'm putting it in bracket. Disposal here refers to equipment A. Right? Addition refers to equipment C. Right? Are you following me or not? Yeah. What you add is equipment C. What you dispose is equipment A. Okay. So you go and include that here at the initial cost for equipment C. This one is at initial cost for equipment C at initial cost. And for equipment A that was disposed at cost is what you include here. So at the end, it will be 245. For motor vehicle, there are no changes because you don't buy any new motor vehicle. So then you can total up the total section here, the cost of the two types of asset there would be 585. And now we go on to the accumulated depreciation. The balance that we have here is from the from the question itself. Okay, 92,750. Where do we get this? You must ask that to yourself. Where do I get? That one is from the question itself, where this is actually the one here. 80 plus 12. So if you look at 80 plus 12, 750, 80 plus 12, 750. I will color differently now. I use orange, and I use some different color here. Where was it? Apa nak pakai ni? So I use this. Right. Okay. Orange. Oh, it doesn't want to go orange. Never mind. 80 plus 12, 750. So that 80 plus 12, 750, you will get 92, 750. So that was the first one for equipment. This 118125, where do we get this? This is from the one under motor vehicle. 112,500 plus 5625. 112,500 plus 5625. 112,500, which is, sorry, yeah, this two. If you add up 112,500 plus 5625, you will get the beginning balance here, which is 118,125. 118,125 again is from 112,500 plus 5625. So that will give you the figure here, right? This one. Okay. This one is from the one earlier. All right. So you have the total accumulated depreciation balance at the beginning of the year, 210,875, coming from two motor vehicles and also two the equipments. Depreciation is from our working just now. Depreciation from our working, and our depreciation was 51,000 and 32,450 respectively. And you can also notice that there is one more line item in the accumulated depreciation. You have 90,000. This 90,000 refers to this 90,000. This one, the yellow item. So I put here. This 90,000 relates to that 90,000 that was the accumulated depreciation eliminated on the date of disposal. And that 90,000 is 80 plus 10. Total up, you have 35,200. You have 35,200. Then total up here, no changes, just the depreciation, 169,125, and you get 204,325. The carrying amount would be 245 minus 35,200. 340 minus 169,125, you get 170,875. And this 380,675 is the carrying value, or the carrying amount. Carrying value or the carrying amount that is at the end of 31st of December, year 12. And that would be 380,675. And this is the one that you will report here. 380,675. Okay. So this is the carrying amount. So it's not that that fast to get this. You need quite some time to digest, right? I know. But make sure that you really use this as a sample of how to do things, right? Because this would be asked in question 1 of the final exam. In question 1, published account, you can be tested on depreciation relating to the addition and disposal, where it comes to the notes on PPE. However, in question 2, you will be asked like all those format that you have noticed when you were doing your tutorial questions, tutorial 2. But in question 1, PPE are still being asked, but it will be asked in the notes to the PPE, and also the presentation in the statement of financial position and the impact here. If let's say you have a loss, this would be part of admin expenses. Let's say you got loss on disposal, so it would be part of expenses. Okay, I'm done with it. We take a break. I'm going to stop recording. Am I still with you? I hope so.
Yes, madam.
Okay. Uh,